This is a story all about my biggest investing mistake. The purpose of this video is to share my failure to help you avoid the same or similar pitfall in the future. How much this mistake cost me doesn't really matter, and believe me, it has cost me. The fact that it's cost me money doesn't mean it's a mistake though. It's everything which came before it in the form of red flags which is the mistake. For curious viewers, I will share the story and the numbers in the video, but this isn't the core topic. I want to go through the telltale signs of investing mistakes. So in this video, I'm going to be going through 5 red flags that you really need to look out for. Here we go. 1. The investment found you, not the other way around. This one seems obvious, but think it through. Did you get pulled in by the hype of an investment? Think about recent examples such as Bitcoin, Tesla, GameStop, CCIV or Nikola. Who's doing the thinking? Is it you, or is it an influencer or a media conglomerate? We see this sort of influence outside the investment world though. We've all seen a news report where some Sunday school teacher is being prosecuted for acting violently during a protest, which is completely out of character for them. How can somebody who is reasonable, caring and thoughtful act in such a manner? Well, for the very reason why you're an intelligent investor and you're very level-headed, you can still make some really poor investment choices. In psychology, it's referred to as social contagion. In the case of a Sunday school teacher, seeing someone throw a rock through a store window validates the action and significantly increases the chance of the others in the crowd doing the very same thing. Either of these two, influencers or the media giants advocating for the latest IPO, can really start a knock-on effect where people will buy in on the back of it and then others will see them doing it and they'll jump in off the back of it. Can you see the trap here? I'm not saying that either Bitcoin, Tesla, GameStop, CCIV or Nikola are bad investments. In fact, I hold both Bitcoin and Tesla. It's more about why and how you end up investing into these companies. If the investment has found you, then tread carefully. You're most likely hearing it from someone who has a lot to gain from you buying into their pick. So have they really got your best interests at heart? Equally, are they really going to give you a different point of view of why you maybe shouldn't invest into that company? Probably not. My advice is to start doing more research from several different sources to build up your own picture and own understanding of what is best to do for you. This also has the additional benefit of making yourself a lot more comfortable with the decision. 2. You're in a rush and at some level you might be in some pain. We've all been there. 1 minute we're not aware of something, the next we're absolutely incensed with having something which hasn't been on our radar forever. This could be many things in life. A designer top, a new makeup range, a brand new collectible, the latest model of car, the next altcoin. You catch my drift. It's like suddenly you're in a small amount of pain just by not having this one thing. Once you're in this hole, it's incredibly hard to get out of. My best advice is to look out for these telltale signs. If you're starting to feel extreme hunger for something which you weren't even thinking about a few moments ago, then really question, why do you really want it? Why is it so important now but it wasn't before? If your decision is driven by fear of missing out or by the trashy and also confusing motto of you only live once, then it's a sign that your decision hasn't really been well thought through. To give you some insight in my costly mistake, which is relevant to this point, I was sat in McDonald's at 8:15 in the morning somewhere on the outskirts of London, sometime between 2018 and 2019, I can't remember. I was meeting a colleague before a big meeting we had with work. But instead of doing my final prep for a meeting, I was desperately trying to connect to the Wi-Fi at McDonald's before the markets opened to invest £5,000. Why couldn't I have waited to do it until I got home? Do you think I was in a rush to do it? I think so. 3. You can't answer simple questions about your investment. This is a huge red flag. If you're struggling to answer really simple questions about your investment, then you need to question what you're doing. If you've invested into a company, then you should at least know what are the different streams of incomes, which one is the biggest, which is the most profitable, which one is growing the quickest. But you might not be able to understand this level of detail if you bought into an index. But you should at least know how many companies are contained in it, what sectors are they in, what are the rough geographical weightings. Those sort of things really are a must. If you don't know this, then you've probably most likely fallen for red flag 1 and red flag 2. Another way to reflect on this point is with the following. Wouldn't you feel really stupid if you suddenly found out that a company you'd invested into was actually partly owned by a company you thought was a bad investment? But then what if your investment conflicts with some sort of personal value? Animal testing, human rights breaches, significant climate change contributor. You might not think it's important until you read a report saying that they're testing sun cream on rabbits. Yes, literally burning rabbits tests the difference between factor 20 and factor 30. You might be thinking that's a really weird example and that I've actually made it up. but it's not. I actually knew somebody whose job it was to do that. How comfortable would you feel about investing into a company now if they were doing those sorts of things? You really need to be doing your research. Red flag number 4. If your entrance strategy is weak, then your exit strategy is going to be even worse. There is one common link between all investors I know, between the good ones and the bad ones. The reasons for investing vary, but their exit strategy is always less solid than how they've got into the investment. So we've looked primarily about getting into investments, but another big hallmark of any investment mistake is being clueless about how they're planning to exit that investment and what to do in various situations. First, what is your exit plan? I'm sure you've got into your investment of choice for the reason of getting good returns, but what is that return? And then at what point do you cash out? What sort of time horizons are you looking at? A weak reason will look like simply not knowing or actually being forced to liquidate your position for external reasons. A little bit more on this shortly. What happens if the investment shoots to the moon? At what time do you cut and run? But then what happens if the worst happens? Instead of solid gains, your investment is sinking lower and lower. At what point do you cut and run, or do you stick it out? You can see by not having answers to these pretty simple questions that it might lead to far bigger problems in the future. An investing mistake can be made even worse if you have no idea how to end or exit your position. Red flag number 5. You've put money in that you really can't afford to lose, or at least need it for something more important in the future. We all do the numbers. If we think the stock is going to significantly grow, then the bigger our initial number that we deposit, the bigger the return is going to be. This is why it's incredibly tempting to stretch yourself more and more. If Bitcoin is going to 100x, then £1,000 is going to get you £100,000. But then again, £10,000 would make you a millionaire. Look, it's great to dream, but what are you putting on hold by stretching yourself? Maybe you're forcing yourself to not have an emergency budget. Maybe you know that you'll need a deposit for a house in the next 18 months. Or worse, maybe you have outstanding credit card debt that you really could do with paying off. But before any of these life events crop up, I know how I would feel if my investment of choice dropped through the floor if I'd put myself in these sorts of situations. You'd really feel the screw tightening, but then you'd be forced to probably double down as you're thinking surely it'll go back up. When these events do finally crop up, you're going to be in a massive pinch point. You might have to exit your position and take a solid loss, or maybe actually investment's gone nowhere, but in the meantime your credit card debt has really snowballed to the point where paying off the interest is starting to really cause an issue. Your dreams yesterday are now taken away from your dreams today. The bigger your investment decision, the more this needs to be thought through. To quantify what a big investment decision looks like, it has nothing to do with the actual amount. Someone investing £100 could be a bigger decision than someone investing £100,000 because it all comes down to 2 factors. The first is how big is the investment as a relative percentage to your overall investments, and 2, how critical is that money? If you've never invested before and it's your first £100, then it should be extremely well thought through as it's 100% of your investment portfolio. If you've got a £10 million investment portfolio, then actually £100,000 is only 1%. It's not really worth sweating over before you invest it. To my second point, how critical is that sum of money to you outside of investing? Could this money be used for your first home, or could it pay off some high interest debt? Or is it a bonus which actually you could use trading up from an Audi A2 to an Audi A3 for example? If it's the latter, then you have a lot low risk associated with that decision. So these are my 5 red flags to watch out for. I believe these are some of the biggest factors and the biggest challenges to investors today, especially with the rise of investing apps. So let me tell you about my single biggest investing mistake. I can't remember all the details, but I remember most of them. I was made aware of a UK listed company which had recently been massively sold off. I think it literally dropped 90% or something like that. My friend believed that the company was massively oversold and it was going to definitely bounce back. I actually invested £1,000 into this stock, and within a short time I'd made a £300 profit. I sold out and pocketed the money. It wasn't a smart investment as I literally knew pretty much nothing about the company other than the fact that it sold off. Skip forward a few months later and 2 things happened. 1, I received a bonus from work, and 2, the same company's value had dropped massively again. So I thought, why don't I buy back in? I made loads of money the first time, so I'll make loads of money this time. I took £5,000 of my bonus, which at the time was 20% of my investment portfolio, and jammed it back in. The strategy was foolproof, right? So I jumped back into the stock, and within 9 months it had lost 83% of its value. From investing my initial £5,000, I only had £850 left to show for it. It was a very hard and brutal lesson, but I got what I deserved. You might say, well, it's only £4,000 lost, Nick. I can see from Youre's channel that that's less than 10% of what you now have. It's spilt milk under the bridge as such. Sadly not, it doesn't quite work like that. There is a significant opportunity cost that you need to consider. To demonstrate this, I could have easily invested that money into my Vanguard account. So I'm going to compare the performance of this £5,000 if I'd invested the £5,000 in my Vanguard account and then also benchmark against the investment that I'd made in this UK listed company. Since 2019, my Vanguard account is up 17%, but this alternative investment is down 41%. We obviously don't know how they're going to perform in the future, but let's make some assumptions. Let's say the market is going to grow around 8% on year on average, both my Vanguard account and for this company that I've invested into. If I choose to retire at say 60, so 30 years from now, what would be the differences between my two choices? Well, after 30 years, my investment mistake would be worth around £31,000, but if I'd put that money into my Vanguard account, it'd be worth £63,000, so a £32,000 mistake. So 50% of my current investment portfolio in just one mistake. The earlier this mistake has made your investment career, the bigger the impact it's going to have in the future. Imagine if I had another 10 or 20 years of this to compound. So you might be sat there thinking, Nick, what are you going to do about this mistake then? Well, I want to be really transparent, as I'm not always that rational, because after all, I am human. Logically, if I do not believe this investment, which if I'm honest, I don't, and I don't have any strong convictions about it in the long term, I should really cut my losses and invest this money back in somewhere where I do have a strong conviction. So, my Vanguard account, for example. But if I'm honest, emotionally, I don't want to do it. If I sell where I am right now, I'm locking in a loss. And this thought process I'm stuck in is a fallacy of sunken costs, but I really don't want to sell. If I'm honest, I'm loosely holding on to the hope that the share price will recover back to its initial buy point, and then I can actually confidently sell out, and then I can say to myself that I haven't lost any money, even though I've lost the opportunity cost. Again, I would then likely reinvest that money into my Vanguard account, but who knows. So there you have it, my biggest investment mistake. I would love to say it would be my first and last one, but hey ho, let's see what happens in the future. I would love to know though, have you fallen foul of any of the 5 red flags that I'd outlined? Maybe you've been close to one of these mistakes, but luckily pulled away from it at the last minute. Do let me know in the comments below. I'd be really interested to know about your personal experience, as I guess I've just shared my personal experience. I do other videos on this channel around investing, finance and income growth. These include updates on my investment portfolios, so my biggest one I've probably mentioned is on Vanguard. Then I do have other investment portfolios, such as my crypto portfolio on crypto.com, so feel free to check them out. That's all for this video. See you in the next one.